Hey everyone, Dan again, stocktrades.ca. We're getting a ton of emails this week, and the number one question we're getting right now is what the heck is going on with Tesla? This is probably one of the more popular stocks in the US. The stock, I think this morning, has already traded over 18 million times. And if you look at the analyst estimates here, they are all over the map, ranging from strong buy to get rid of it. So why is a company who posted a net loss of nearly $1 billion last year returning so much to shareholders? I mean, if you were to buy the stock in May of 2019, you'd be up around 322% right now. And one of the primary reasons for its short burst recently is something we call a short squeeze. And that's something we're going to be going over in this video and explaining to you why Tesla's price has jumped so much in such a short span. And whether you're watching this today when we publish it or a year from now, this video on short squeezes is going to be relevant then, much like it is now. We're just using Tesla's stock price as an example. So let's get started. So what exactly is a short squeeze, and why does it have the potential to drive a stock's price significantly higher, especially in Tesla's case? I think in order to understand this, we first need to understand what exactly is happening when an investor shorts a stock. So let's go over that first before we get into the short squeeze. So what do you do when you find a stock that's significantly undervalued and you don't own it yet? You buy it. And what do you do if you find a stock that's significantly overvalued and you don't own it yet? Well, you sell it. That's exactly what a short sale is. You're essentially borrowing shares from your brokerage and selling them on the open market. And in return, you get cash for your sale. So how exactly does this turn into profit? Let's go over a quick example using Tesla. Say you want to short sell Tesla, you believe it's overvalued. At a price right now of around $768, you decide you want to short 10 shares. Your brokerage would lend you 10 shares, and then you would sell them on the open market for $768. Your account balance would be $7,680. Because your brokerage typically charges you interest on the shares you've borrowed, you optimally don't want to hold them too long. So what you're hoping for is for Tesla's stock price to fall. So if we short Tesla for $768 and the stock price falls to $500, we can buy those shares back at $500, and as you can see, we have $7,680 in our brokerage account, and it only costs us $5,000 to purchase Tesla's stock back, thus profiting $2,680. So it seems like a pretty genius and easy way to make money, right? And that's where a lot of people run into problems, because there's a massive difference between buying a stock and short selling a stock in terms of potential losses. If you buy $10,000 worth of a stock and it falls to $0, your loss is $10,000. You can't lose any more than that. But as you can see here, if you short sell $10,000 worth of stock and instead of going down, the stock's price triples, you'll end up paying $30,000 to buy those shares back. Analysts often say that Tesla is bleeding cash, and with a net loss of nearly $1 billion last year, like we said, it is one of the most heavily shorted stocks in the world. If you were to have taken $20,000 and shorted the stock back in May of 2019, you would currently owe your brokerage almost $85,000 right now. That's $85,000 in just 8 months. If you were to have shorted the stock in September of 2019, you would owe your brokerage around $65,000 in just 4 months. And if you were to have shorted the stock just before Christmas last year, you would owe your brokerage a little over $36,000, which is almost double your initial investment in just under 2 months. So these are some catastrophic losses in a fairly short amount of time. And this is even if your brokerage lets you keep the position open. A lot of the times your brokerage will liquidate your position at a certain price point so they can recover the money that you owe them. And if that does happen, you're essentially out of luck. Your position is closed and your money's gone. So now that we know exactly what is going on when you short a stock, let's go over why Tesla's stock price jumped so much in the past while. So we know when we've shorted a stock, we've borrowed shares from our brokerage and sold them on the open market. So in order to close that position, we need to buy those shares back. And what happens when you buy shares on the market? The stock price goes up. So there is nothing more terrifying to a short seller than a stock that's currently turning it around and is on the upswing. And why is that? well, their losses are now infinite. And as such, they may feel pressure to close their short position and buy their shares back. So most of these short squeezes need some sort of catalyst to get them moving. And Tesla reported fourth quarter earnings on January 30th. And the company actually delivered some pretty bold expectations. They want to deliver over 500,000 vehicles in fiscal 2020. And since then, the stock's price has been on somewhat of a rally. And as such, short sellers are closing their positions, driving the stock higher and intensifying the short squeeze. Yesterday, Tesla gained over 20% in a single day of trading, and they estimate that short sellers lost $2.5 billion. And as we sit this morning, the stock's down about 14%, and the catalyst for this was delayed deliveries from their factories in China due to the coronavirus. And this stock right now fundamentally just doesn't make sense. When Tesla's stock price approached $900 yesterday, it had doubled already in 2020, and we're only a little bit more than a month in. Compare this to the returns of the S&P, which are around 1%, and Tesla is currently outperforming the index at an unsustainable rate. So a lot of people defend Tesla by saying they have the electric car market cornered. And while this may be true, you can look no further than tech companies back in the late 1990s. Amazon is one of the biggest companies in the world right now, but at the time they were trading at price points that exceeded $94. And after the bubble burst, they lost nearly 90% of their value. And investors who bought at those peaks would have taken 8 years just to break even. Tesla was trending all over the world yesterday, which is clear a lot of investors were buying into the stock. But if you know the true reason why the stock was going up, which is more than likely because of a short squeeze, then you know this is more than likely only temporary. And we would suggest taking extreme caution if you're looking at the stock right now. So before we close out this video, head down below, like the video, subscribe to the channel, and I'm going to leave you with one of Warren Buffett's most popular quotes: "Price is what you pay, value is what you get." This is absolutely critical in the case of Tesla, and right now, fundamentally, this stock just doesn't make sense.